With many portfolio managers electing to hold a large number of shares in their portfolios in order to get exposure to the broad swath of the JSE, some people would deem it risky to hold a concentrated portfolio of 15 to 20 stocks. But this is exactly the approach that Rezco Value Fund has adopted. Now, here to discuss the shares of the fund and those that they've been investing in is Rob Spanjaard. Rob, thanks for your time. When I was looking at your portfolio, there were two things that struck me. One, you are still in some of the retail shares. So you are in Mr. Price, you're in the Foschini Group, and then you also hold a large amount of cash in South Africa, 23.58%. Surprising for me, given the fact that we do know that cash has, interest rates are sort of fairly, underwater, if you like. Whereas when you look at the retailers and the way they outperformed last year, some people are suggesting that perhaps this is not the year of the retail, and we've seen Shoprite sort of affirm that.
You got quite right. Our fund is a balanced fund, so we can't have more than 75% in equities. So the balancing number, obviously 25%. And what we're finding at the moment is that we're finding much better value offshore. So we're using we can invest 25% of the fund offshore. So we're using that as much as we can. So you'll see there's very little foreign cash. So we're using our full allocation. That leaves a balancing number of about 50% invested locally. We would agree with you on the retailers. We had much higher holdings of retailers through most of last year. Companies like Mr. Price, we had up at about 7.5% of the portfolio. So we've been selling down. And in fact, those numbers you got there, yes, we've actually lower than that now. We've been selling out. We don't like these retail numbers. It just doesn't.
They're not looking too good.
We've had a fantastic ride on those shares.
Yeah.
But the party is getting stale, I
Absolutely,
think.
Especially after the news that we saw with Amplats potentially losing 14,000 jobs and potentially other miners coming to the party as well. But what about that large cash holding here in South Africa?
Well, we have to hold a certain amount. We can either be in bonds or in cash.
Yeah, and you've chosen cash.
Well, at the moment, bonds don't really have anywhere to go except down. I mean, interest rates can't really get much lower in our opinion. We've got some bonds, but there's a risk element in bonds where you can lose money on the bonds. So we feel cash is a safer bet at the moment. On top of that, also, we're an emerging market. So what happens is if there's a crisis, everyone becomes worried about emerging markets, about South Africa. The equities go down and the bonds go down at the same time. So holding bonds doesn't counterweight your risk. And what we're trying to do for our investors is reduce risk the whole time. Just take risk, make money. So we've got a slogan which is preserving capital, creating wealth. So we're always trying to do those two things. So it's how do you moderate the risk?
It's quite an interesting approach, Rob, because I look at many equity funds and they have, there's so many shares in some of the portfolios I look at. I'm quite amazed at how portfolio managers actually keep track of what's going on in their portfolio. You guys take quite a different route. You have a concentrated portfolio. I think I counted 16 shares to give you your exposure to the JSE.
Yes.
What's the thinking behind that?
That's one of the fundamental pillars we believe in investing, our fundamental pillars, that you must have conviction. Either like the thing or don't own it. So a lot of guys, there's a temptation always to index. So if you, for example, banks say with 10% of an index, you don't like banks, you have 7%. If you love banks, you have 12%. We don't do that. We index ignorant, agnostic, atheist. We don't follow indexes at all. We like a share, we own it. And when the investment case for that, we like to hold a share for 5-6 years if we can. But there's a quote by John Maynard Keynes: when the facts change, we change our opinion. So if the environment changes, then you have to not own that share. So only own shares that you really believe in the investment story.
Yeah.
And just to talk onto that, it's kind of balanced from an industrial perspective. If I look at the company, you've got Discovery Holdings, R&B Holdings in there. You've got a bit of Sasol. You've got some industrial shares in the form of Omnia and Barloworld. You've got some listed property. What are some of the changes you say that the South African market's looking pretty expensive at this point. Have you been buying anything recently?
We can find much better value offshore, but as I said, we can only find 25%. We can only put 25% of our offshore. Companies that we still like the investment case for is companies like Omnia. That's got a great. We think it's got a great couple of years ahead of it. Also starting to try structure the portfolios to companies that benefit from a weaker rand. We're particularly worried about the current account deficit, the trade deficit, as well as the budget deficit. that should mean we'll have a weaker rand over the next couple of years, which is fantastic for certain companies. It's not necessarily a negative, but you just need to be in the right companies.
Yeah. At the same time, though, your biggest punt, if I may call it that way, is Omnia. What's the story there? What are you looking for? What are you seeing?
We still believe in the commodities play in China. And you know, they're still going to use a lot of commodities. We just worry about in commodities that the new supply is going to overtake the demand, which will push the price down. Because margins are very high in the commodity industry. So as those margins come down, Omnia, one of their big divisions is explosives, particularly open cast mining, which is expanding in southern Africa. So it's Zambia, South Africa, Mozambique, and that's a very good. So people will still use a lot more explosives. It's a much better way to have an exposure to commodities. Another side of it is they do fertilizer, which is Southern Africa, South Africa, with very high international grain prices. People use more fertilizer. That gives them a robust pipeline ahead of them as well.
Just in terms of turning our attention to your offshore portfolio, a lot of big names in there. I'm interested, you also take a slightly different route from some of your peers. You invest directly as opposed to using a fund of fund or a mandate managed by someone else. You've got some bulge bracket companies in there. I always am interested in finding out what makes you buy these companies when they are so well researched and covered, and why do you think if you see value in them, they've been neglected?
You know, we think it's a fantastic opportunity for our clients to own some of these top companies in the world. At the same time, on all those companies, we believe we've got an idea. We don't just invest blindly. And the fact that they're very well researched means you can get the basic fundamental research very good on those companies. But you often have you need to try to find an angle investment idea. Why is that a good company? And we believe we add a lot of value to our clients by being able to do that. Just innovative, fresh thought.
Yeah.
And you know, the market isn't always right. You're not trying to be too clever, but you get out there, there's some fantastic growth opportunities, there's good companies. You know, it's a bit the argument, if there was an opportunity out there, someone else would have taken it. The market does severely misprice equities at various times.
Right. Let's get into that. You've got quite a big stake in financial companies. We're thinking about MasterCard, JP Morgan Chase, Wells Fargo, and Bank of America, which I think together amount to about 10% of the portfolio. What are you seeing in those big US-based financial organizations?
Are you listening to Warren Buffett? He says the banks are safe.
Yeah, he listens to us. The banks are good. They're good quality organizations. So a lot of people are still worried about the financial crisis, but the big play in the US really is the housing market. That's recovering very fast. So you're buying a quality institution like JP Morgan, which is our biggest bank holding. You know, it's kind of below 10. That company we believe is going to make 15% earnings growth over the next 2 years each year. If you saw today, they've just announced results where they're about 20% better than analysts' forecasts. And if you just look in that housing market, the numbers coming through, it has to translate into bank results. So that's a good example. So we would look at analysts' forecasts, and we're just a strong conviction these guys are being way too conservative, which is why we would own that. MasterCard is also a very interesting thing, worldwide company. There was a legal change in the US which forced companies to offer an alternative. So they couldn't just offer you Visa. Visa had a much bigger slice of the American market, but it would force the guys to offer you an alternative, which was very good for MasterCard, and a good play on emerging markets. So a lot of these companies are playing emerging markets, and we believe a much better way to play them than trying to invest, say, directly in China or something.
Yeah. Interestingly, amongst the technology stocks, you have Apple and you have Samsung, and there's a raging debate about who's going to win the war here. Now, we saw Apple yesterday closing below $500 for the first time in 11 months, and your biggest holding, though, is in Samsung. Are you saying
we fall very on that debate, on that side of the debate? We Samsung guys. If I had my phone, I took it out before I came into the studio. The Samsung phone.
Right.
We've still got the Apple holding. We had a big Apple holding. We bought much lower down, which we've been selling out. The problem, it fell probably a bit quicker than we had a lot of debates. Buy Samsung, so we did that. Sold most of the Apple holding. You can see the Apple holding still is quite small.
Yeah.
We just feel at $500 a share, it's probably too cheap. Samsung, fantastic company, are managing to outperform Apple in the smartphone market, which is almost people didn't believe was possible, producing fantastic products. You know, the fantastic thing for our clients is they're getting this company on about a 10 PE going forward. You know, 2-year forward PE of about 8. So you're getting a world-class company, fantastic products, good growth, and you're not even paying a 10 PE for that.
Yeah, one of our directors here will take you on about the whole Samsung Apple thing, but you don't have Facebook.
Facebook, we believe, was completely overpriced. Hot. Everyone loved Facebook, but it was just totally overpriced. The problem with Facebook, they need to show that they can actually make the millions and hundreds of billions of users. You know, I think they're up to about 1 billion by now. But how do they make money out of it? Google have done that fantastically well. They know how to. They've learned how to monetize the people, the hits on their site.
Just to finish off, you've got Google and Intel in there, and one other company I wanted to just ask you about before we go is Palco. What exactly is that?
Palco is a small Japanese.
You have 30 seconds, Rob.
Japanese retailer. We got in when it had its entire market cap in cash. So that you got the whole company, it had cash sitting in the bank, which was the value of the company. Same time, you're paying 8 times earning, and the thing's growing at 15%. That's value investing for us. That's the situations we love.